If you're getting ready to retire and have questions like how much income you'll be able to safely withdraw and what you should be investing in, but you don't want to pay somebody 1% of your assets every year just to find out, this video is for you. I'm Ethan. I'm a chartered financial analyst, and in the last 20 years, I've helped over 1,000 financial advisors build portfolios for their clients. And now I'm going to teach you how to build your own ultimate income portfolio in 3 easy steps for free. As a bonus, I'll even throw in 2 funds that I would make the core of my own income portfolio if I were going to retire tomorrow. There's a lot of misinformation out there, so before I dive into what you should do, allow me to very quickly address 2 common approaches that I would strongly suggest avoiding. 1, oh, I'll just build it so I'll run out of money at 85. I probably won't live that long anyway. Yeah, but you might. Or you might have higher expenses than expected due to medical issues as you get older. Do you really want to take that risk of being in your 80s and running out of money? I wouldn't. Number 2, and even more common, oh, I'll just invest in the highest yielding things I can find to maximize my current income. And I assume that income will stay consistent forever, and I just won't worry about what's going to happen in 20 years because I just don't know how to assess that. Horrible idea. We've explained why in many other videos, so I won't rehash it all here, but in one sentence, typically products with really high yields, like 8 or 10% or higher, are not sustainable and will provide you a falling income stream over time, which is the opposite of what you'll need given that the prices of pretty much everything you're going to be buying will go up over time. And that brings us to our first and most important step to creating a retirement income stream from your investments. Make sure it goes up. This is what consumer prices have done over time. How often do you see this chart going down? Not very often, right? So if we want to maintain our lifestyle through retirement, we need to make sure our income can grow along with the cost of the things that we'll have to spend it on. I'll show you how to do that a little later in the video, but for now, the main point is that creating a growing income stream should always be your true north when you're building an income portfolio. Number 2 is finding the right balance of risk and reward. For a simple example, let's start by imagining the most aggressive portfolio possible, 100% lottery tickets. It's got the biggest possible payoff if you win, but that's highly unlikely to happen, and if you don't win, you go bankrupt instantly. Way too risky, obviously. But on the other hand, imagine the most conservative portfolio possible, keeping everything in a savings account, which will earn you virtually nothing. Unless you're just extraordinarily wealthy and live way below your means, this likely won't generate enough return for you to retire and live the lifestyle you want. You won't instantly run out of money, but you almost certainly will run out of money eventually, and that's not good. So too aggressive won't work, but too conservative won't work either. It's all about finding the right balance. Later in the video, I'll show you exactly how to do this, but before we get to that, let's move on to our third step to building your ultimate retirement income portfolio. Don't focus on the income. Wait, what? Yes, you heard that right. For an income portfolio, don't focus on the income. I know that sounds crazy, but here are 2 reasons why. The first one is simple. Dividends are inconsistent, and that adds an unnecessary level of stress in your life. I don't know if you've ever worked for commission, but I have, and I don't miss it. If you're used to getting a regular, steady paycheck throughout your career, and then you go to try to rely on dividends for your income in retirement, all of a sudden, your income is going to start bouncing all over the place, and you won't have any idea how much you're going to make in a given month. That just adds a level of stress that you don't need in retirement, especially since there's a better way, and it's so simple. For the second reason that you should ignore dividends in your income portfolio, let's go through a quick example using the American Fund's Income Fund of America. I simply picked this fund because it has a long track record, and it looks a lot like a retirement income portfolio that someone might create for themselves. It's basically designed to be a complete income fund, hence the name Income Fund of America. It's a mix of bonds and dividend-paying stocks with about a 2-to-1 U.S. to international ratio on its stocks, and it's focused on producing high income and some additional long-term return potential without too much risk. To show you why you should ignore the dividends, I'll take you through what would have happened over the last 30 years in 2 different scenarios. One, where we take out the dividends as our income stream, and the other, where we take my preferred approach, a systematic withdrawal plan. If you don't know what that is, don't worry, I'll explain it in a moment. In our first scenario, we start with $1 million. We're looking at the last 30 years, and where it says reinvest capital gains only, that means we're taking the dividend out as income. I'll start by showing you the full illustration in case you want to pause and zoom in, but it went on to 2 pages and it's kind of small here, so to make it easier to see, I'm going to zoom in on the end. Over 30 years, you started with $1 million, you took out over $2 million in income, and you ended up with over $3 million at the end. It's as easy as 1, 2, 3. Amazing results. And you can see there on the bottom right that the return was just 8.77% per year. That's good. It's solid, but it's not spectacular or unachievable. This is what really would have happened in this fund over the last 30 years if you just put $1 million into it, took out the income, and stopped worrying about your investments the whole time. But you saw your income fall 3 years in a row from 2002 to 2004 and many other times throughout that period. It did basically double over the full time, so it met our number one criteria of making sure it goes up, but it certainly could have led to some stressful periods over the course of the years. I'm going to keep our final figures from the taking dividends example up at the top as a point of reference. But in our second example, we keep the same $1 million investment in the same fund over the same period. But instead of taking out dividends, we reinvest them. And to generate our income stream, we start a 5% systematic withdrawal plan. That's 5% of our initial investment. So $50,000 in the first year. And we give ourselves a 3% raise each year to keep pace with inflation. Let's see what happens. Again, here's the full time period if you want to pause and take a look. And I covered up the dividend income this time since it's not relevant when we're reinvesting it. And in my opinion, it just makes it harder to follow along. But let's zoom in again so we can get a better look at how it turned out. And here you go. The final numbers, if we'd taken dividends, are up at the top, and the final numbers under our systematic withdrawal plan are at the bottom. With the exact same investment, you are able to take out almost $200,000 more in income, and you had over $100,000 more money left at the end. Oh, and the bonus, your income rose steadily every year. No drama. That's why I'm such a strong proponent of ignoring the income your investments produce and setting up a systematic withdrawal plan instead. It's simply a better approach. It's also super easy to set up, by the way. It would probably take you less than 5 minutes to do it, and I'm going to show you how in less than 30 seconds. This is for Schwab, which is what I use, but I'd expect it's fairly similar no matter where your account is held. You go to Move Money, then Online Transfer, then you decide what to sell, which investment account to take it from if you have more than one, which bank account to send the money to, and how often you want to get paid. Simple as that. You might have to go in once per year and adjust the amount for inflation, but that's it. Easy. I don't know about you, but I think I'd be willing to do that for an extra $300,000 or so. It's incredible how such a tiny change that's so easy to make can have such a massive impact on your life. Another thing that's incredible to me is that 75% of you that watch this channel regularly haven't yet subscribed to it. So can I ask you for a favor before we continue? If you like this channel and you're getting value out of it and you want to support us, the free and easy way to do that would have a massive impact on our lives is simply by hitting the subscribe button. My commitment to you is that if you do that, my partner Carlo and I will do everything in our power to help you become a better investor. Thank you so much. Now let's get into how to build your ultimate retirement income portfolio using our 3 steps. Make sure it goes up, find the right balance of risk and reward, and ignore the income. The key to building a portfolio that you can use to create a sustainable, growing income stream over time is making sure that it's likely to produce enough return, which usually means a couple percent more per year on average than you're going to be withdrawing, and we want to limit the volatility as much as possible. To show you why limiting the volatility is so important, I'll take you through a very simple example. If you have a steady 8% return with no volatility, so you earn exactly 8% every year, you can take out an 8% income stream and you'll never lose money. On a $1 million portfolio, you make $80,000 every year, you take out $80,000 every year, and you're back at $1 million every time. If instead, you introduce some volatility, which is how it works in the real world, Your portfolio's average total return will need to be higher than the income you take out. Here on the bottom, we earn the same 8% average annual return and take out the same $80,000 of income each year. But instead of earning 8% both years, our return is 0% in the first year and 16.64% in the second year. That's an 8% average annualized return. In this scenario, even though we earned the exact same return and took out the exact same amount of income, we ended up with about $7,000 less after 2 years. Why? Because of compounding. That's also why it's 16.64%, not 16% in the second year to get to an average annual return of 8%, by the way. In the first example, you earned $80,000 of return on your investment in the first year, and that's what you took out. So you ended up back at $1 million. That meant your year 2 return was based on your starting portfolio value of $1 million. But in our other example, your return was 0 for the first year, but you still took out $80,000 of income. So your ending portfolio value was only $920,000, not $1 million. And that means that your strong year 2 return of 16.64% was only based on the starting value of $920,000, not $1 million. That's why volatility matters when you're building an income portfolio. If you were not taking income, you'd have ended up in the same place with both of these portfolios, because in that case, the only thing that matters is total return. If you are taking income, higher volatility will effectively lower your overall return. That's why it's so important to consider it. To sum it up, your portfolio needs to produce 2 things to be able to create a sustainable, growing income stream. It needs to produce a high enough return, higher than the amount of income you're taking, and it needs to do so with as little volatility as possible. The more volatility there is, the wider the gap needs to be between your portfolio's long-term total return and the income you're taking out each year. So we need a high enough return potential, but we also need low enough volatility. And that leaves us with a dilemma. Remember the lotto ticket versus savings account example? High results are better, but lower volatility is also better. And usually those don't go together. So how do you find the strategies with the right balance? Well, for an individual investment, one simple metric to look at is Sharpe ratio. This basically measures how much return it's gotten per unit of risk. So, like how attractive the risk-reward profile is. Higher is better. You can find this by going to morningstar.com, typing in any investment you want, and going to the Risk tab. Easy. But at the portfolio level, which is all that really matters if you're not just going to invest in one thing, there's an even better way. It involves Monte Carlo analysis, which you can get free through the Portfolio Visualizer tool. If you haven't used the Portfolio Visualizer, it's free and it's awesome. And they're not even sponsoring this video. They just really deserve the praise. If you Google Monte Carlo analysis, it should come right up. Monte Carlo analysis is basically a tool that helps solve for the fact that the future is uncertain and past results are not always perfectly predictive of what will happen going forward. In fact, they pretty much never are. It takes your portfolio and projects it out thousands of times in the future to estimate all the possible outcomes and show you what's likely to happen. We really don't know if things will go well or if they will go well over the next 20 years or 30 years. Will interest rates go up or will they go down? Will the U.S. do better or will non-U.S. do better? We really don't know. But we do have a ton of history to draw on, and we do have a pretty good idea of how different types of investments typically behave in different market environments. And that is enough to allow us to test out different portfolio combinations, different withdrawal rates, different contribution amounts, different time horizons, and get a better idea of what is most likely to be the best way going forward. Now I'm going to show you how. We're here at the setup screen for Monte Carlo analysis in the Portfolio Visualizer tool. Then I'm going to take you through a couple different scenarios as we build our way up to our ultimate income portfolio. You can go in and do this yourself with your own real numbers, but this series of illustrations will just show you how to use the tool, what kinds of investments I like for retirement income portfolios and why, and what a realistic withdrawal rate might be. I'm not going to cover everything here, but just going in order with the important ones, I selected asset classes at the top. That means general expected returns for those asset classes. We'll get to specific investments in a couple minutes. We started with $1 million. We're withdrawing $4,167 a month, which is just $50,000 per year. or a 5% withdrawal rate on our $1 million portfolio. We're going to adjust that income stream up along with inflation, like we talked about earlier, and we're going to take it out monthly for 40 years. Are you listening for our three main steps here? 1, make sure it goes up. We're adjusting for inflation. Number 2, find the right balance. And that's what we're going to do by looking at these different scenarios. 3, ignore the income. And we have a systematic withdrawal plan set up. I did pre-tax returns because, well, I don't know your tax situation. And if most of your investments are in a 401k or IRA, some or maybe even the majority of your income might be tax-free anyway. So there's too much variation. Plus, when people say, I make $50,000 a year, they almost always mean pre-tax. So showing pre-tax here will simplify things by putting them in the same context that you've probably always thought about your income in. For the definitions of a lot of these other things, you can either hover over that little black circle with the I in it or read some of the definitions in the fine print on the top that I showed earlier but didn't talk about. I'm not going to take you through all of them now because honestly, I just don't think it's a good use of your time. So $1 million, $50,000 a year of income, increasing with inflation, sustainable for 40 years. And at the bottom, you can see we've got a 60-40 stock to bond portfolio with 2/3 of our stocks in the US and 1/3 of them outside the US. And our bonds, they're tax-free municipal bonds. Pretty standard retirement income portfolio. It projects out 5,000 times and there's only about a 70% chance that we'll make it 40 years without running out of money. That's not good. It tells us that in the medium period, we could have taken out a withdrawal rate of almost 6% and been fine. But in case things don't go well, a 4% withdrawal rate would have been safer and kept us safe over 90% of the time. Still, that wouldn't make me feel comfortable, and I think we can do better. What if, instead, we decide to, say, add a few more stocks, go a little more stock heavy, and we have maybe 80% stocks and 20% bonds? Everything else is the same. Well, here, we improved our survival rate a little, but not enough to make us feel very comfortable. Now, in the median scenario, we actually could have taken more than 6% and been okay, which makes sense since stocks usually beat bonds in the long run. But in the lower scenarios, we actually had a smaller safe withdrawal rate, a little under 4%, because there are a wider range of possible outcomes when you have more stocks. On average, you're likely to do better, but you're also taking more risk of doing worse if things don't go well. That's where we have to try to strike a good balance. Now let's look at the same two scenarios with real funds, starting with our 60-40 portfolio. Here, I've changed it to historical returns since we're using real investments, not generic asset classes. We've got UPEC, one of my favorite international funds for international, the mutual fund version of VU, most people's favorite US fund, and Fidelity Intermediate Bond for the fixed income portion since it's one of the oldest bond funds out there. For the bootstrap model, I selected block of years and set it to 20 for the minimum. I strongly suggest setting it to at least 20 if your investments have long enough histories to do that, because otherwise it will give you some unrealistically bad outcomes. This basically lets it use the same period over and over again. It's random. So when you run something 5,000 times and are doing it with just 1-year periods, some of the simulations are just going to have a whole bunch of 2008s in there, which probably isn't realistic. So I like to force it to use 20-year periods because I think that is a more realistic way to look at it. It's more reflective of what is actually likely to happen. You will likely have some good years and you will likely have some bad years. And if you run it 5,000 times with only a single good year, you might get a lot more bad years than is realistic and about a lot more good years than is realistic some of the time. So it'll, I think, distort the outcome a little bit. So I like to take longer term periods. I think that's a more realistic set of what you could actually get over a longer term period in your retirement going forward. Okay, let's see how it worked out. All right, you've got an 89% chance of not running out of money. Look good, we're getting somewhere. And our safe withdrawal rates are going up too. That's good. But what if we switched it to the 80-20 portfolio like we did with the generic asset classes? All right, our survival rate is a little higher. That's good. And our safe withdrawal rates are a little higher too. All right, we're getting somewhere. So maybe somewhere closer to 80% equities is better than somewhere closer to 60% equities. That's what we're starting to learn by playing around with this tool. But in my opinion, there's an even better way to build a retirement income portfolio than what we're doing here. I prefer flexible investment strategies. The reality is, a fund like VU is not trying to win the volatility, and it's never going to invest in anything other than 100% US stocks, no matter how unattractive they might be at a given time. Same thing with bonds, and pretty much any strategy that's focused on a single asset class at a single region. You could try to actively manage the allocations yourself, but that's time consuming, and if we're being honest, the vast majority of people just are not very good at that. But the reality is that sometimes you do want more stocks, like, say, if the market has just gone down 30% and it's likely to recover. And sometimes you do want more bonds, like if the stock market is at an all time high valuation and it's probably not sustainable. So that's why I like flexible funds that can invest in both stocks and bonds so that I don't have to do the work myself, but I can have a professional constantly deciding what is most attractive within certain parameters that I want my income strategy to have. So, for example, I don't want them to be able to go to 100% stocks one day and 100% bonds the next, but I do want them to have some flexibility to adapt to changing market environments. Two of the absolute best funds that do this, in my opinion, are the American Funds Capital Income Builder and Vanguard Wellington. Wellington has been around almost 100 years and it invests about two-thirds of its assets in stocks and one-third in bonds, both primarily in the US. It's generated amazing results over time with a nice balance of decent returns and moderate risk, and it comes in at an insanely cheap 0.25% expense ratio for an actively managed fund. Capital Income Builder is a globally diversified multi asset, meaning stocks and bonds, approach to building income. It tries to produce an income stream that's consistently growing, just like we want in retirement, and that's higher than the average yield on US stocks. Now, remember, we don't really care that much about the yield, but it says that approach may lead to equity like returns with less volatility than global markets. Now, that's not a guarantee, but what was our dilemma? We want equity like returns, but we don't want equity like volatility. They believe this approach can help them achieve that, and historically, since 1987, it has. You can see from the asset mix that it's got about 10% more stocks than Wellington, and its stocks are global, almost 50-50 US to non US right now. It's a little more expensive than Wellington at 66 basis points, but still pretty cheap for an actively managed fund. So let's see how a portfolio split evenly between these two flexible funds with historically high Sharpe ratios might do in our scenario. Well, look at that. A little less than 4% chance of running out of money, the best we've had so far. And a higher sustainable withdrawal rate if things don't go well. But actually, look what happens when I change the block of years to 30 instead of 20. Remember, that just means I'm taking real 30-year periods instead of real 20-year periods for projections. The results should be more consistent over longer periods in general. And boom, I can't even show you that survival chart because it doesn't exist. I don't know if you can see this, but in the fine print on the bottom left, they say they ran this scenario 10,000 different times and you never ran out of money. In fact, you could have taken out 5.75% withdrawals and it would have been sustainable 90% of the time. Remember, our withdrawal is 5%. And actually, at our 5% withdrawal rate, I know it's hard to see, but you had a 90% chance of growing your $1 million retirement income portfolio to at least $2.5 million by the end of the 40 years, even after taking out all that income. You had a 50% chance of growing it to over $8.7 million. So as you go through this tool with your own information, that's something you can play around with. Do you want to take income and have your money grow so you can leave it in inheritance? Or do you want to maximize your income potential without the risk of running out of money? You can adjust the tool to reflect many different scenarios, making contributions, different tax rates, time horizons, withdrawal scenarios, whatever. But hopefully, this has helped you get a really good understanding of how to use it and what the three most important steps are to creating a sustainable, rising income portfolio. I've also given you two really solid ideas to start with. These are not investment recommendations, and this is not advice, but if I were retiring tomorrow, Capital Income Builder and Vanguard Wellington would be the core of my income portfolio. And if you want to see the full income model portfolio that I've built, or the growth and income portfolios, you can do so by joining the Fundamentals of Finance Academy, where you'll get access to bi-weekly calls with Kyle and I, a community of investors bouncing ideas off of each other, access to my personal portfolio, and all current and future course content. If you really want to take your investing skills to the next level, in my opinion, that's the best way to do it. There's a link to join below in the description. But if you're more of a set it and forget it kind of investor, I hope you found this video helpful. And if you have, please show us by hitting that like button and subscribing to the channel. We really appreciate you sticking around for the full video, and we'll look forward to seeing you in the next one.